some positive feedback. Maybe we give some negative feedback. We just want to set proper expectations with our people.
There's just no loans on the street.
We want to help as many people as we can. That's obviously always our goal.
If you have a 6% 30-year fix, you have a 5 or a 4 tickler on ARMs.
Don't just rush into that decision. Give them the time and the opportunity to understand what they're actually looking for, why they want what they want.
I can go from 1,500 or 2,000 to 3,500.
Welcome back, episode 2 of the Brady Haye Mortgage
Team.
Oh,
the second
podcast,
annual, huh?
The more official version of the first episode.
Good.
Pleased to be joined today with my good friend here, Dave Hendriksen. Yeah, just excited for kind of the growth of this podcast, where it can go, kind of what just to kind of bring you up to speed. Obviously, since I kind of threw you into the mix here, the goal of the podcast and as it grows is to really give business professionals and people that I interact with on a day-to-day basis, entrepreneurs, and a platform to share kind of what they do, why they do what they do, what impact they make on their people, and really why they should work with them. Wanted to bring you on just obviously some context into what you do and really the behind the scenes of our company, and share some insight and some of the value that you've learned over the years of your career, and be able to frankly shoot the shit with you a little bit as well, which is going to be great.
Well, I appreciate you having me.
Yeah, absolutely. To kind of start things off, I guess, kind of just share with the listeners kind of who you are, what you do, and then we'll kind of dive into it a little further.
You bet. So Dave Hendriksen, been in the business about 23 years. Started off in the banking world with a company called World Savings, which was then acquired by Wachovia. Okay. So originally started off on the wholesale side as an AE, selling to mortgage brokers throughout the country. Then moved into management, I believe, in 2005.
Got it.
So 2005 was a branch manager overseeing 11 AEs at the time.
Yeah.
And then I would say 2007, when Wachovia acquired, I was pushed to the retail side to start the retail operations essentially in 7 states.
Got it.
So it sounds bigger than it was.
So, but we're talking, I mean, what is this? What's it been 30 years though, since you've kind of gotten into the mortgage industry?
So 23 years that I've been in the mortgage
23
business
years.
So
you've seen a lot of it.
That's why I'm 45, but I look 70.
Oh, stop. I would never have said that. You want to talk about why you got that hat on today?
Yeah, I got a few zits underneath this lid. Kind of wear it like,
hey, we're all human, right?
Cover it up a little bit. That's right, baby. That's right.
No, I think that's one of the super unique things that, and one of the big reasons why I wanted to have you on today is just the experiences you've been through, especially with the nature of our market that we're going through right now. I think, especially from a local standpoint, because frankly, as I'm sure you're aware, things are a lot different here in the Midwest where I'm doing business compared to nationally where you're handling. I mean, you're having conversations all over the United States. And so I think it'd be really interesting to have you share, kind of what you're hearing out there, what the nature of the market is, what, maybe we give some positive feedback, maybe we give some negative feedback. We just want to set proper expectations with our people as far as what to expect from a mortgage standpoint moving forward. I know that I obviously can't predict it, right? We have no idea, and that's kind of the thing is we'd all make a lot of money if we knew what was going to happen next.
Well, I wouldn't have to do this podcast.
Correct,
right?
yeah.
Or make another sales
this podcast
call.
That all 20 or 30 people are going to be listening to probably, but no, I think that's the key point that I want to drive home today is just kind of some state of the unions pieces of it. What are the conversations you're hearing out there? All of that good stuff, and just really provide some value from a market standpoint and compare it to things you've seen in the past, or maybe it's brand new. Yeah, just kind of share some insight there.
So to kind of rewind here, and then in 2008 I kind of got into business for myself, right? Okay. And then with a little pit stop to help launch Caliber Retail, which got acquired by New Res. So I think that market for sales leadership.
When you say that market, you mean
07, 08
market,
right? It was tough. However, where it differs from this market, right? So you had a financial meltdown, but there were still loans on the street. So I think people, because we have a quick way of forgetting, and 07, 08, there were a lot of loans on the street still, right? Yeah. You had renters taking advantage of the opportunities because you had values of real estate
decrease. So it was easier
crazy,
to purchase because they were more affordable.
You had HARP 1, you had HARP 2, right? So the Hochbergs of the world that had been in it, and the Cornishes, and some of the Alex and some of the guys that work nationally as partners got in right around then, and were able to really capitalize on an opportunity when a lot of loan officers, mortgage bankers, or bankers were so frightful they kind of ran away from the industry.
Of course, sure.
If you fast forward to today, there's just no loans on the street, and I think that That's probably the frustrations I'm hearing on a national level from the real estate agents. Now, there are markets that there are exceptions. So what we're seeing is more like, you know, low state income tax, like very low or none.
Okay.
Some of those pockets haven't seen the slowdown that we've been experiencing for really 8 months in the Midwest, right? So
you think that's mostly income driven? Like, is that they're still able to bring home maybe some more dollars and they have some more to spend on housing? Is that why those specific states probably are?
I think it is. I think if you really look at the data, like you got a lot of the Northeast where values have really held and went up. And
Sure.
so when they come down to, let's be real, you leave Manhattan
Right.
and you come down to Clearwater Beach, Florida, it looks like a steal.
Right.
Now to you and I living in the Midwest, it doesn't look like a steal.
Correct.
Right. But to the New Yorkers and things like that,
Sure.
you're seeing that Florida market hold. What's interesting for the first time in the last 45 days, I'm starting to see Denver sit.
Okay.
Right. Austin is having massive issues. So, you know, if you really follow the history of the tech software and everything, used to be Silicon Valley.
Yep.
They kind of got fed up with the prices, listened to their employees. A lot of companies moved down to Austin.
Got it.
But with software struggling right now with the current economy, you know, Microsoft on essentially, you know, I don't know if it's still live, but at one point they were on a hiring freeze. There was no bonuses. There was no promotion.
Sure.
So I think the bigger companies such as that like kind of drive the tech and then all the little umbrellas underneath them.
Yeah.
I think that puts a challenge out there, right?
And totally. And I think that's one of the things that I think is probably not talked about enough, is how big of an impact that has on the actual housing market and people buying and everything that goes along with that. I feel like, especially in the last, let's call it 12 months, it's probably been a little bit longer than that, but I think it's been really easy to just point fingers at rates going up, and that's why everything slowed down. There's probably some other driving factors there that has kind of slowed the concept of someone buying a new home too, right?
Yeah, I think, look, I think that you can talk about the Amazon layoffs, all the stuff, right?
Yeah.
But I think if we just don't make it too complex and just look at it from a common sense standpoint. So let's say a borrower sitting there, you know, or a couple sitting there, and they look around the house, they say, hey, you could use an extra bathroom, or man, I really wish this place was updated. But the reality is, if they're sitting at 275 right now, right?
Not going to double that payment,
or 8, right? So my hope would be in the overall state of the market. I truly believe some data points too. If we see a 5-handler on the 30-year fixed, now I think that the couple that we just
be more willing to pull the trigger.
Like, okay, you know what? I can stomach this, right? Yep. I can go from 1,500 or 2,000 to 3,500.
Right.
Right. But they just can't go from 2,000 to 6,200, 6,300. Right. And that's why I say, like, the data is great and helps educate the buyers, the real estate agents. But we always got to put a common sense factor on everything.
And I think that's why, like, from our standpoint, when we're talking with new prospective home buyers, we always start with goals, right? So we're always evaluating what are your goals from a financial standpoint. When you look at your budget, can you afford where we're at today, and then let them make the informed choice moving on from there. And that's really the only way that I've been able to approach it and kind of get through this, because frankly, we still want our clients to buy if it makes sense for them, right? And we're never going to discourage someone from doing that. We want to help as many people as we can. That's obviously always our goal. But at the same time, we got to heart a little bit too, and we got to make sure that we understand what they're going through, and frankly, the financial quote unquote burden that would be required with taking on a new home loan too. So
absolutely, and I mean, even like the borrowers that are in a really good position from an equity standpoint, as you know, it's so hard to get that cash to go buy a second place right now.
Yeah,
right? It's expensive. You could do it, but it's going to cost you a lot.
Yep.
And so I just think if you tie all those common sense factors together, it kind of shows you where the state, like the overall state of the mortgage biz is.
Yep, totally. If you were to, and I know you're not in sales anymore, but if you were to sit down with a client today, how would you approach that conversation? Where would you kind of take that?
I think like if I look at it nationally, right? Like you've got the Des Moines group, you got the Davenport group, you have very similar sales styles.
Yeah.
You move into Chicago, you see it differently. Southeast, definitely a lot different, right? So from my perspective, I've always, back when I was in sales, was more along the lines of you guys. Like, here's the belief, right? Like, if you're truly educating and you have the best interest of the client at heart, like a realtor should want to negotiate the best deal for their buyer,
of course,
hoping that they get the sale, right? And you don't want to have that uncomfortable conversation if they overpaid for the property, right? When you go to sell that, they say, "Wait a second, I paid this for it, and
now you have to sell it for less,
$600 for it, and you're asking me to sell it for $550."
Right.
So, some of that could be market driven and can't be stopped. But I do believe in the education process.
Yep.
And then the other thing is I really wanted to make sure that the buyer wasn't being emotional, right?
Yep.
So did they fall in love with a wet bar or a butler pantry or
right.
a pool and kind of miss all the stuff that really matters?
Yep, because even especially something that's a resale property, which that's something I'll talk about here in a second, but a resale property that has those unique features like a pool or something like that you're talking about, it can be easy to like draw to that specific feature of the home and overlook some of the other things you're giving up in it. So it's super important, especially, and now I think with kind of the nature of where things are, I think I'm seeing anyways from my side, people taking a little bit more time than what they used to. You talk about the last 2 years with rates being crazy low. We saw people jumping in and making decisions really without ever having to think about what they're doing, and so we're seeing that, at least from my pipeline, I've seen a slowdown from the time of, initial lead intake to pre-approval, and then also a length of time increase from pre-approval to under contract. So I think we're seeing that, a little bit more be careful kind of mentality when they're making that decision on what house, instead of just running right to it and writing an offer on the spot without even looking at it. So
yeah, and I think that's a great point, right? I mean, how many people did we come across that never saw the house during the COVID days, right? They just, even 2021, even after the restrictions were listed, one of my best buddies was on a vacation with his wife, and bought a place in Northern Cal, sight unseen,
right?
So
which it's a little easier to do, right, when you have that comfort to know the payment's going to be low. Like, it's like, okay, well, I can afford this payment. It's a lot more reasonable, but yeah, I mean, to think that somebody's buying a house without ever even stepping foot in the place is actually pretty wild. So, and I listen, there are situations that are always going to probably require that, or, whether you're moving across the country or whatever, maybe sometimes you have to make those decisions. But I don't necessarily think that it's a bad thing that it's kind of slowed everybody's roll a little bit. It's just a matter of kind of navigating that so that we as mortgage advisors can still make a living, and, frankly, still provide the value for the clients that we want to. So,
yeah. And I really hope, and I do think that we work with such great real estate professionals that are able, when the buyer just goes online, sees a house, and says, I got to have this, without stepping foot in it.
Right.
I think that the education's better in the real estate industry now. So
I would agree.
The professionals are able to say, hey, look, let's go see that house, but let's also see, some comps throughout that particular market. Why do you want to buy there? Is it the school district, the kids, whatever it might be, right?
Don't just rush into that decision. Give them the time and the opportunity to understand what they're actually looking for, why they want what they want, and kind of make that decision from there based on what's out there and what's available.
Yeah, and I remember, kind of going through the process myself. Now, this was back in 2012 when we bought our house, but I had to remind my wife constantly, like, listen, when we walk in this house, it doesn't love you back.
Right.
Right? So just remember that.
Yeah.
So, and just to see, being in the mortgage biz and being able to see what she went through on an emotional standpoint, it kind of gave me a different clarity, even though I'd been in the business for 12 years.
Right.
Right.
Well, and you still want that, right? You want to fall in love with the house you buy. There's no doubt about that.
You do. But I can tell you, we probably, look, it wasn't, the information and the pictures weren't as available as they are today.
Of course.
Right. But in the matter of 24 hours, she fell in love with 7 houses.
Yep.
Right.
And you can't have all 7, can you?
Yeah, you can't have all 7. So I think that, like, understanding that really helped me understand, like, the whole process of what we've tried to build here at, Lower, Key Mortgage, all this stuff.
Yep, totally. No, that's great. I think that's super important value add for the clients. And so just to kind of recap and encouragement for you guys is to make sure you're doing your due diligence. Working with a professional is key, both from the lending and the real estate side. Work with a mortgage lender and a real estate agent. They're going to truly educate you guys on the process. Make sure you're comfortable, informed, and educated with all the decisions you're making and navigating this market that we're going through, especially as rates change, as things adapt. It's important to have somebody in your corner. So I think that's a huge point I wanted to drive home. So touch on this a little bit. I read an article this morning that really was talking about kind of the nature, and I think that one of the more commonly known headlines in real estate right now is just simply the fact that inventory is the issue, right? And with the amount of people that have really low rates on their current loans right now, they don't want to sell their house. We kind of talked about it already, but I'd love to hear your thoughts. It sounds like the article I read this morning is that new construction prices could end up dropping lower than a resale home, moving forward. What's your thoughts on that market and kind of how you think that'll impact things?
So I can tell you, just, being blessed with all the leaders we have throughout the country, you definitely can see a reservation from some builders right now, right? So it went from, we can't keep up. So they just keep building,
can't build enough
building
houses,
and building. I think some of the issues, right? And I bet you could tie it right here to Des Moines, not knowing the Des Moines market like you and all the professionals you work with. But, let's say that there's a track home. Let's just use simple number, right?
Yep.
So let's say it's semi-custom, right?
Okay.
Which is the new thing, right?
Yep.
So semi-custom, and it's going for 600,000 right now. You got all the amenities. You're excited about it. However, it's in a little bit different school district than some of the established communities.
Sure.
Right. So if the rates go to 5 and the inventory opens up all the time, the problem let's just keep it right here, right? The problem those semi-custom builders are going to have is if 800 was the established community with a better school district to get in, and 5 or 600 was the starting point for the builder building the semi-custom or track home,
yep.
Right? There's going to be a gap there. So the buyer might look at it and say, hey, look, you know what? For the house that was worth 800 is worth 725 now.
Right.
I can afford 725. I couldn't really squeeze into the 800 is the buyer's perspective.
Sure.
But we really want to be in that school district. And that is something that should scare builders.
Yep.
Right?
For sure.
So
you think you'll see some scale back in spec homes and in that side of things, or what's kind of your expectation there?
I think it's going to be interesting. I don't know the answer to that, but opinion wise, right? I would just look at this and say, if I were a builder and I had all these properties built,
right.
You would know exactly what your margin is in them,
yep.
Right? And I would want to get out of that as quick as I possibly could if the rates went into the 5s. Right. Now, the flip side is that's encouraging for the builder is because it all works in price points. So maybe the family that owns a $250,000 or $300,000 house, they can't get into the 750.
Sure.
But they can get into the builder house, right?
Right.
With some incentives and things along those lines. So
sure.
It'll be interesting to see how this plays out. Builders are resilient. They're great.
Yeah.
They'll figure it out.
The good ones hopefully have some cash flow to deal with too, so they've got some wiggle room there. So.
Yeah, I think that's the other part, right? That no one's talking about is a lot of their operating lines, right? So their business lines are through these mid-sized
everything
banks
they're borrowing against is also getting more expensive.
They've constricted.
Yeah.
Yep. And they got some of the mid-sized banks, as we've seen, First Republic going out and things along those lines. They're having a liquidity crunch. So it'll be interesting to see where's the builder going to secure their capital
funds
lines
from
in order to expand on the subdivision.
I
don't know that, but I do know that builders are resilient and they'll make it work.
Yep, I love it. I want to kind of wrap things up with probably the most desired topic that I get asked all the time is just around interest rates, kind of where things have been, last 12 months, where we've been in the last 60 days, and then what your professional opinion is on where you think things should go and where they will go. And I know you don't know any answers, but I'd love to hear your thoughts on it.
Yeah, so I think that it's just such a unique market in the secondary spectrum of it right now, right? So the margins are just compressed. And so
give some context into that real quick before we move forward.
I'll tie that in.
Yes, simplify the concept of the secondary market for both my real estate agents and my clients listening. What is a secondary market? Where do those rates come from? I know what the answer is, but I want to have you educate the listeners
so I think
too.
Let's just keep it really simple, right?
Okay.
So, historically, there'll be a certain margin, right? That comes back to the mortgage bankers.
Okay.
And then you'll have banks competing for a pool of loans, just to keep it really simple, right? And so banks start competing, and then all of a sudden, the customer is actually going to benefit, right? Mm-hmm. Because it's like, hey, we'll give you this rate, and if the sales force can deliver that rate, it'd be great, right? Well, right now the banks don't want the loans, right? Because their predictions, most of them, are that rates are going to go down over the next 2 years. So why would you want to pay for a loan today,
knowing it's going to get rewritten?
Knowing it's going to get rewritten, right? So that's the unique thing, and that's why you see all this imbalance. I mean, historically, you've been in it long enough. Like, if you have a 6% 30-year fixed, you have a 5 or a 4 tickler on arms, like a 7-year arm.
Right.
That doesn't exist right now. Right. So it's really the banks showing us like, we're not really interested in it right now. Right. And we've seen that with one of the largest that we've ever worked with getting out of correspondence. I think that, I would say that if rates don't go down in 24, I think the mortgage industry is going to be reshaped.
In what way? Where do you see it would go? So let's say hypothetically rates stay at 7% throughout 2024. What?
7.5.
Yeah. Where would that take you?
I would say this. I think that it's going to put a lot of pressure on the mortgage bankers, the entire independent mortgage banker, the brokers, everybody. It's going to put a lot of pressure, right? And I just know that when you look at the bigger companies out there from the mortgage banking side, they're bleeding a lot of money.
Yeah.
A lot, right? They may have a lot of money, but they've bled it for 17 months. So I just think if they have to extend out another 12, 13, 14, 15 months, it's going to put a lot of pressure, because what we're forgetting is last November, October, all these companies said, hey, we're bleeding. We're going to go out and buy everybody, right? We're going to pay big signing bonuses. And then the spring market's going to hit and we're going to get our money back.
We'll recoup all those funds.
And then the spring market didn't hit.
Yeah.
And neither did the summer market.
Right.
And neither has the fall market yet. So I think that's why I would say I think that there'll be a reshape of the financing industry. Mm-hmm. Don't know what that means. Don't know what that looks like.
Sure.
Just really hoping that all the professionals you work with and yourself as a professional was smart about saving the money back in, a couple of years ago when we were kind of saying, hey, it's going to get rough.
Right. For sure. No, that's, and the weird part about it is that there's not really anything we can do about it. We just got to kind of sit back and kind of let it happen. So continue to take care of our people locally is really what I'm putting focus on, is just making sure that I'm providing value to my local people, and hopefully we make it through it. But
I think the one thing I would tell you is that I do know nationally, like I feel really comfortable with the company we've built, and more comfortable even with the referral sources we've acquired.
The
professionals, the real estate agents, the accountants, the financial planners.
Yep.
Like for you real estate agents, one of the things that's really working in Chicago by an LO is he approached all these divorce attorneys.
Yeah.
Right. So divorce attorneys, they have all these clients. So 90%, we met with one of the bigger ones in the Chicagoland area. 90% of his clients that come to him looking to settle a divorce end up in some form of real estate transaction.
Yeah, either a refinance or a sale and a new purchase, or sometimes two new purchases.
Absolutely. So we were able to take one of our preferred realtors into this divorce attorney, and she's been able to pick up, I think in 3 weeks, she's picked up about 7 or 8 listings.
Isn't that crazy? You never want to wish upon divorce by any means.
But it's going to happen, right? 50% of the people
it's inevitable.
Divorced,
yeah.
Right? So it's such a good path. So like the real estate agents, the loan officers out there, really encourage you to try to really dive in and look at it. And, I'd be more than happy to talk to anybody about it that wants to call me.
I love it. Just to kind of end things off, I know that one of your big focuses from your day-to-day operations is around recruiting, talking with other loan officers, potentially seeing if they'd be a good fit with our crew. Any tips or advice you'd like to give with our group, kind of what our vision is, how we're trying to grow, I want to give you an opportunity to kind of sell yourself a little bit, I guess.
I want to say it would be selling myself. I would say this. I think back, if I rewind 10 years ago, right?
Yeah.
We would take any LO on, right? We were just chasing numbers. That was kind of the game.
Sure.
I think when I looked at the overall business at that time in 2013, I realized I was more in like a Kerry Canopiate's role, or John Cornish role, very involved in the loan process.
Sure.
We couldn't grow. We couldn't scale, right? So we kind of got maybe a little bit too big too quick, right? When I stepped out of Kerry's role. Now what we've learned is we really want to work through it with like professionals. We are very picky. We do turn down a lot of LOs, a lot of branches.
Sure.
I think that you have to have a partnership with everybody you work with, right?
Yep.
And if you can't sit down and have the real conversation, then what are we doing? And I think, I look at it this way. I think there's two types of LOs. Right. And so this will probably piss off half the LOs, but it's true. Right. So you've got and it really does fall in this range nationally if you exclude the coast, because those loan amounts get out of whack. But
sure.
You have loan officer A, who is a $15 to $25 million producer. You go on their LinkedIn. They move every 3 years. It's part of their business strategy. They take a signing check. And then towards the tail end of their tag expiring, they start bitching about everything the company does.
And that they don't do, for that matter.
You don't do this, you don't do that. Those individuals can't sit down and have a conversation, even if the P&L, the data, raw pricing's in front of them.
Right.
They just can't.
Just doesn't align. Sure.
Then you have like loan officer B, who holds complete accountability, right? And wants to partner with an organization
to make
grow,
it better. Yeah.
Right. And I think that you and I have a great relationship, played some golf together, definitely had some great times together. That we'll probably keep that out of it.
We'll keep that off the podcast.
Yeah. So I don't remember that part, but yeah. No. So, I think that, we'll just see where we're at now. Is sitting down with people like you.
Yep.
We want to talk to professionals and people that we can invest in,
right?
And they can really grow their business. So I kind of look at it sounds a little arrogant, but I do believe in it enough to where, there's other companies where you can go get your bachelor's degree.
Yep.
And then you can come here for your master's degree.
I love it.
And I think if you're going to get a master's, that means that we got to invest in you. And I think you've seen that, Brady.
Yep. Yeah, and you're willing to do it, and that's I'll be transparent. That's a big reason why I'm still here. Is I can sense that you guys as a company care about us as loan officers, want us to succeed. You're giving us the tools to to continue to grow, motivating us to do the little things. Like it's apparent that you're pouring into us as a staff, and thank you for that for the most part. But
well, we appreciate you guys. We couldn't do it without you guys
for sure. And that's you hit the nail on the head. There is we want to attract a partnership of quality people that just want to do things the right way, take care of the client, take care of the referral partner, and execute at a high level is really, and that kind of ties into our first episode that I filmed with Louie is we really kind of shared the why behind Key Mortgage Group and who we are, what we want to be known as from a brand standpoint, with our real estate agents, our clients, everybody that works with us. And it's not just myself, it's not just Louie, it's our entire brand, it's our entire division. We really want to be known as that group that's going to execute at a super high level. We're going to be diligent in our review process, make sure that we're communicating at a high level and executing for everyone that we interact with. And, I think that would align well with, the way you're looking to recruit as well. So, the thing that Louie and I said is if anybody's ever looking, or if you're a mortgage professional that's, maybe not feeling the value that you may deserve from your current company, it never hurts to have a conversation. So,
yeah. And I'll say this about recruiting, right? And I want every LO to understand this, right? I understand moving sucks. It sucks, right? Yep. Because it's new, and new with new never works.
Right.
Right. So I just want to make sure, like, really, truly, from my perspective, like, are you running towards an opportunity?
Yep.
If you're running away from it, then really we're probably not a fit for you.
Right.
Right. Because that means that we can't sit down and have a real conversation.
Yep.
I think that my hope is, as this organization continues to grow and we've got the foundation laid by, like, really, if I look at this, and I would say Des Moines is if not the probably top 2 in the country in regards to the culture that you guys have built.
Well, thank you.
I truly mean that. And I would say that going back, and look, full disclosure, doesn't mean it's a top producing office.
Of course.
Right? Doesn't do the most volume. But I would say in the last 10 years, in regards to cultures of offices that I've had the privilege of working alongside, like, you guys definitely are top 3 in the last 10 years.
Love it.
Right? And so I really like what you guys are doing out here. I would like to see some more like-minded professionals join you guys. I think the culture you have here is something that it's an opportunity for everyone.
Totally.
And then the last thing is would love to just educate anyone in this market on the loan officer side as to how this really works. Like, I can promise you this, if you take a massive signing bonus with a 3-year tag and an interest rate attached, if you leave early, they're going to get their money back.
Yep, for sure. And I think even one step further, I mean, it doesn't always come down to just the dollars and cents, right? Don't ever chase just a big check. It's important to partner with people who you align with well and want to see you grow and succeed. And that's where I found my home here is surrounding that. So no, that's awesome.
And I would tell the LOs that don't want to move, right? That are happy. Like, if you do get in a position, because I think here, if I get real and we transition into the loan officer here, and rates stay at 7 or 7.5 for 24, loyalty is going to start getting tested pretty quickly.
Right.
Because I can tell you this, I'm loyal to all you guys, but not as loyal as I am to my kids and wife.
Right.
And so if the LO's facing,
got to pay the bills.
I don't know if I can pay the bills.
Yeah.
Right. So I think companies right now, and I did tell our CEO, I said, look, you're so focused on recruiting right now. I think that's great. Right. And I think it's an integral part of the business. I think the companies that aren't focused on retention are in trouble, right? Because they may have a false sense of loyalty, but again, the people become broke and they're forced to take a check.
Yep.
So I encourage LOs that like where they're at, if they do get in that spot,
have the conversation,
right? With somebody that's a partner, your boss, whoever it may be, to say, hey, look, I don't want to go, but I need some help here.
Yep.
Right? Like, I can't do this. And I know there's money on the street. Right. And so what will be really interesting, though, is if this path continues, let's say 8 months from now, we're still at 7.5 or 8. Are the signing bonuses still there? And that kind of ties
those companies
all
have
together.
The liquidity to offer at that point.
Reshaping the mortgage industry is kind of what I mean in regards to that.
Yeah, for sure. Well, no, it'll be interesting to see it all unfold. I can't thank you enough for coming on and providing your value and frankly just being a good friend.
Same. You're a great buddy, and I appreciate the opportunity to do this. And
I want to leave you with this one last kind of funny plug. Is my friends and my listeners know that I'm a chicken wing guy. Tell me your favorite chicken wing you've ever had, and where was it at, and what flavor would sausage would you be having on it?
I can tell you right now, For sure. And I'm usually a fried. Like I don't like a batter, but I do like the fried regular wing.
Yep.
However, there's a place by me called Old Town Pub that has a grilled chipotle sriracha sauce. And they're the best I've ever had.
I'm going on a wing tour, so I got to try them out. So,
well, when you're out by me and we play some golf, I'll take you there.
I'm in. We'll make it happen. Well, Dave, thanks again for joining us. This has been the Brady Haye Mortgage Team podcast, and we'll see you guys next episode.